Hello, everyone. Welcome back to the channel. Matt with Green Bar Trading here. Welcome back to another weekly watch list video where we're going to go over everything you need to know for the week ahead. Before I do, please hit the thumbs up for the video. And if you are new, consider subscribing. All right. So what you have in front of you here are the earnings for this coming week. Now, we're going to get a very good view of how the consumer is and how the consumer spent their money. We have Target, Best Buy, Macy's, Lowe's, Costco, Kroger, all these huge companies that really have a direct relationship with inflation and the consumer spending. So we're going to want to hear what the CEOs have to say in their earnings calls and what guidance they have to offer. All right. We've been seeing a lot of not so great guidance for the consumer, and that's expected when inflation is so high. So that's the earnings there for the week. Going over to the economic calendar now. I'm going to show last week and what we saw because last week had a very big influence on bonds and equities. With what we heard from the FOMC minutes, all the Fed speakers, and then on Friday, the PCE that came in. And we've been in this basically since the FOMC actual meeting, February 1st, the markets are starting to price in the fact that the Fed is going to have to keep rates higher, maybe even raise them higher than expected, because the bond yields have gone up since this meeting on February 1st. So it didn't help any this week once we saw the PCE index came in hotter than expected. This is an inflation gauge. It's the number one inflation gauge that the Fed likes to look at. And it wasn't a good report as far as inflation goes. So, there you have it. You basically have inflation still an issue. You have a very hot economy. Retail sales were huge in January, and we just haven't seen the job market loosen up at all. All right. And all of that leads to higher prices for you and I, right? The consumer. So that's not good. The Fed is just not going to like that. Price stability is their number one goal. Prices are too high for things, especially services, so they're going to have to continue to work on that. So rates are not coming down. I know that it's been out there that maybe they would pivot, lower rates. I don't see it personally. I don't see that happening, but anything's possible, and that's just my opinion. Okay, as for this week's economic calendar, there's a lot of Fed speak. A lot of Fed speakers each day are talking. Other than that, it's pretty light as far as, those big reports that we see move the markets. There is not any of that this coming week. So we don't need to worry about a CPI, a jobs report, a PCE report, all those big reports that really move markets. It's going to be all about the Fed. The Fed is going to continue to hammer home that we need to keep rates higher. And that's what you're going to hear probably all week long. And you can see here, every day there's a Fed president speaking. So that's the economic calendar for this week. Now, how did the economic calendar from last week affect the bond market? And like I said, ever since that FOMC meeting, February 2nd, it has gone, the meeting was February 1st, but February 2nd, the market started to take notice that bond yields should not be going down. They should be actually going up. And that's what you see there with the blue line. That's the 10-year Treasury yield, and it has gone up 13.8% in 1 month. The NASDAQ is this yellow line. You can see every time the bond yields go up, the NASDAQ, the tech stocks come on down. All right, that's what we've seen here in February. January was a different story. January, the bond market was not pricing in the fact that the Fed was going to keep rates higher. And it just simply wasn't in. We saw a nice rally in January. All the garbage stocks that made no money, went up huge percentages. Those are all going to come back down to reality. So that's the bond yields there. All the bond yields have gone up. If we take a look here on the treasuries, so you still have that heavily inverted yield curve where the short end is yielding more than the long end. When you see an inversion like this to this magnitude, it's almost always predicting a recession. So that's the bond yields there. Looking at the sectors for the week, this is what we see, a lot of red, right? So I don't know if you remember, but technology, that 1 month relative performance, every weekly watch list video we made, technology had this huge green bar way out here. And we had said then that things were going to start to reverse. All right. We were going to start to see the consumer defensives, the utilities. We were going to start to see those outperform technology, consumer cyclicals. And that's what happened last week. All right. So, and that's what is starting to take place. So that's your sectors right there. Now, going over to our compass. Yes, the SPY. So in last week's video, I called out really well that we were going to come down to right around this area. If you do not believe me, you can watch last week's video. That's exactly where we saw the market pulling on back to. And we did see that pullback to that point of control, the 50 moving average, the 200 moving average, and this ascending support trend line. All right. So what happened this past week, we called out. Now, what I'm thinking, if this is going to be a legitimate bottom that we saw back here in October, if this is going to be legit, we should see a move up now, or at least holding this level if the market is really for real. So that's the SPY there. We'll see if this area holds up. Now, going over to the Qs, this is the tech, all the tech stocks, the NASDAQ. This is currently finding support at the 200 moving average. Now, what hasn't happened yet on the NASDAQ, we haven't seen that golden cross like we saw on the SPY, right? When the 50 moving average crosses over the 200. It's usually a decent sign that the market should start to stabilize. At least, not see a huge drop. That doesn't mean it can't happen. We had the death cross here. That's not good. And we've seen, obviously last year, everybody knows that the market had a very tough time since that death cross happened. So we'll see if this golden cross starts to, stabilize the market. But what we haven't seen is it happen yet on the Qs. This very, very similar thing has happened in 2000, 2001, 2002 during the dot-com bubble. The 50 came close to the 200, like it's doing now. It's coming closer, but then separated. And it actually took a couple of years before it continued to cross back over. All right, so on the Qs, we have that point of control down here, closer to the 50 moving average. So we'll see where we go from there. If we look at the Fibonacci retracements, where do we see the 50% mark? Well, it looks like it's around here at about 287, 288 area for that 50% retracement. A lot of times, if a market is strong, price will come back to this level and you could see a bounce at that 50% area. So that's right around that 287. And that 287 pretty much splits the uprights between the 50 and the 200. So keep that on watch there. Keep that level on watch if the 200 does not start a rebound. So if we break that 200, maybe that 50% retracement is an area there with the 50 coming up next. Last week, we were in this pennant. The pennant broke down, and now we're showing severe weakness in the Dow Industrials. Still over the 200, so we can see some support there, possibly. But this trend line, this broke, all right? So now it's no man's land. We need to just figure out if it's going to hold the 200. Looking at the IWM, you're on a similar situation as is the SPY. You had that golden cross. It was looking strong. It pulled on back, but it's at this trend line right here. So that's all the small caps. That's the Russell 2K, which is the IWM ETF. Now, taking a look at a couple of charts. mRNA. Do you guys remember this from a couple of weeks ago? I had pointed out that this was looking and setting up like a head and shoulders pattern. What a head and shoulders is you have the head here, right? You have the left shoulder, you have the right shoulder, and then that continuation to the downside. But the RSI is extremely oversold, very oversold. So I would be looking for a bounce at some point here with mRNA. Pfizer, also in the same situation. This stock, it's oversold, very oversold here. Same as mRNA. This one is at support though. So you can see maybe we could get a double bottom here and Pfizer can find some support here for a move up. Extremely oversold. Target, we have earnings for this week. Can we get a gap fill right up to this area here? That's a huge move from where we are now. And we are kind of just trading right in this range. Could not break out of this 180 area. But if earnings come in really good, you have that golden cross starting right here. Maybe we can see that bearish to bullish reversal. But that 180's it's gotta crack first. And with earnings, if you're trading options, keep in mind you're paying a heavy premium. So if the move doesn't go in your way, I think the expected move is like 8% or so. You're going to get crushed. So just be aware of that if you're trading options. You need a big move in your favor. Okay, XLF, this is the financials. We had a nice run up here. It's even held in February when a lot of stocks were pulling back. It did pull back to this trend line. So what I would be looking for is the bank stocks to maybe start to make that higher high. What we have seen is this trend of higher lows. And that's what this trend line is. This is support. So as we pull back, maybe we could then make a higher high. So we'll see if the bank stocks follow suit with this bounce off the trend line. Okay, so the last chart we're going to look at is Apple, because Apple broke its 200 moving average. That's never a good sign. There's a ways to go before that 50 moving average is support. So I would be looking for Apple and the market to show us the way, right? Apple is such a huge weighting on the market. The chart does not look very good at the moment. And that breakdown of the 200 is also not a great sign. So we'll just have to wait and see about that. And like I said, a lot of stocks follow the overall market. So where the market is going, and that's why we always look at the markets from a bigger picture, where the markets are going, most stocks are going to follow. So it's really important to know that. Okay, guys, thanks for watching. Hit the thumbs up for the video, and I'll see you on the next one. Take care, guys.